Good afternoon, everybody, and thank you for joining us. The noonday gun has just gone off here in Cape Town, and welcome to our regular Thursday investment webinar brought to you by Real Estate Investor. And today's REI investment webinar is officially sponsored by Wealth Masters, creating generational wealth with property in everlasting specialized trusts. For those of you that don't know me, my name is Neale Petersen. I'm the founder and content-in-chief of Real Estate Investor, South Africa's leading independent digital real estate content and education platform for over 15 years already. We geared for investors, landlords, property practitioners across the board, property developers, and entrepreneurs, delivered by our specialist team of journalists, digital architects, content and marketing specialists. And at REI, we are really passionate about serving the South African real estate community through our content platform, rei.co.za, through REMAG, our monthly digital interactive magazine, and our regular webinars, virtual events and conferences, as well as via Metaverse Spaces, which is a platform. It's the only commercial metaverse platform that puts your business into the metaverse. And at REI, we also help you to create your own customized 3D branded metaverse so that you can sell your products and services. So I'm really delighted to be your host and your moderator for today's webinar. And Wealth Masters, our sponsors for today, will shine a light and a spotlight on uncovering the best property structures in South Africa and Mauritius, and also discuss general asset protection. So moving on to our discussion today, uncovering property structures in South Africa and Mauritius. So without further ado, I'm going to introduce our panelists for today. And first of all, I'm going to say, Johannes, do you want to just introduce yourself to our audience?
Yeah, thanks, Neale. My name is Johannes Maree. I'm the CEO of the Destinata group of companies. We work quite closely with the Wealth Masters Club to implement the systems and processes that they have designed. So we share a lot of clients. My background, I'm a chartered accountant. I'm also a real estate practitioner. And then I'm also registered with the FSCA as a key individual. So I can also do a little bit of financial advice. And then another business that I'm involved in is a Section 12J fund, where we focus mostly on Airbnb properties in the Waterkant area in Cape Town. So property is a big passion of mine, numbers as well, and I believe the two work quite nicely together. Our property is probably the thing where numbers is the most important and where it can paint you a picture. What really excited me about property from a young age is that with the Excel spreadsheet, as long as your assumptions are fair and equitable, you can actually tell the future. And property is one of those asset classes where you can get it pretty close, which makes decision making a lot easier. And so my view, it's an easy thing to take a long-term view on, and that's what I love about it.
Fantastic, Johannes. It's great having you on the panel.
Thank you.
So let's just dig a little bit more deeper into these, these trusts versus personal name. What are the tax benefits of having assets in trust versus your personal name?
Okay, yeah, so the protection side, Coert has already touched on, and a little bit of the tax. So I'm going to look at it from two fronts. On the first front, it allows you to structure your taxable income so that it falls within the entities where you are going to pay the least amount of tax. Let's say if I use a very basic example, let's say I own a property and I make, let's say, about 400,000 Rand a year taxable profit from that property. Okay, so I would now be taxed on that in my personal capacity. Let's say if I'm in the top tax bracket, that would be 45%. If that property was held in a trust, I could distribute that taxable profit. So let's say I had 5 kids, as an example, young kids who aren't earning their own income yet. The tax threshold per individual is around about 80,000 Rand. So in this specific scenario, I would be able to distribute all 400,000 Rand to beneficiaries that fall under the tax threshold, and that would essentially then have zero tax consequences on that taxable profit. So it allows you, the key thing is it allows you flexibility. One of the other things that you could also do, for example, is if you have a business where you had a bad year, for example, and you're sitting with losses there, also gives you the flexibility if that business is also set up as a beneficiary underneath your trust. You could move taxable profits towards that loss-making business as well, where you can use it up. So you can really, it gives you a lot of flexibility to manage your taxes in an absolutely legal way and to reduce your taxes that way. But then the big benefit, and could also touch on that, that is actually on death. And that is the main reason why we don't control the assets of our forefathers. I ran a calculation a while ago for one of our clients who's quite a high net worth person. And, you know, it is a massive chunk of the estate that you lose. And one of the big problems is who dies, say, between 30 and 50% liquid in terms of cash. Nobody, because only a very unsavvy investor would sit on that amount of cash. It's typically tied up in property. And I mean, our tax legislation is not like that of Australia, for example, where the CGT, the capital gains tax calculations, are that they're factoring in inflation. So if you bought a property 50 years ago for R1 million and it's now worth 100 million Rand, even before that property goes into your deceased estate, you now have to pay capital gains on a 99 million Rand gain, and you're not going to have that cash. So what's going to happen? That building is going to end up on auction, and you're going to lose 10% on auctioneer's fees. You're going to lose another 20 to 30% just because on auctions assets go for cheaper. Mm-hmm. So, you know, you can avoid all of that if it isn't a trust, because what happens when you die and your assets are in a trust? Nothing. I get replaced as a trustee. My trust document will already make provision for that, and there would be a succession plan. The bank accounts will carry on as always. The properties will carry on as always, and nothing changes. It's literally, I've now fallen over, but it doesn't matter. Things continue, and that's the beauty of it. So while you're alive, yes, very positive, and it creates extra cash flow for you to reinvest in property or whatever you want to do. But the massive benefit is on death, and as Coert said, that is why most people are not controlling assets of 20 generations worth of forefathers.
Okay, excellent.